the markets are poised to cap off a rocky week on Wall Street with, yes, more volatility. So, should you turn everything in your 401k retirement plan into cash? Financial advisors have one message for you: don't panic. That holds true even as the Dow Jones Industrial Average has had three-digit swings throughout the week. The stock market index plummeted more than 500 points at one point on Friday. Meanwhile, the S&P 500 index dropped as much as 2.2% and flirted with correction territory. Despite the scary headlines, these are signs of a healthy market, said certified financial planner Scott Hansen, founder and senior partner at Hansen McLean Advisors. The market has to go through this sort of thing, Hansen said. The longer we go without volatility, the more nervous I become. I almost welcome a bit of this shaking out. What's more, the markets and the economy are in a much better position than they were in the last dramatic downturns in 2008 or 2000, said financial advisor Ted Jenkins, CFP and CEO of Oxygen Financial. U.S. earnings are still very strong and unemployment remains at an all-time low. In fact, the average correction for the S&P 500 since World War II lasts 4 months and sees equities slide 13% before bottoming, according to analysis at Goldman Sachs and CNBC. The economy, fundamentally, is still very strong, Jenkins said. But if you're in it for the next 5 years, there's no reason to panic. One key thing to consider as you're evaluating your 401k and other investments in turbulent times is how soon you will need the money. Stock ownership should always be for a long-term hold, 5+ years, Hansen said. The only ones who should be nervous right now are the ones who have to sell in the next year or two to fund retirement income or a purchase. If you do need the money in the short term, you probably should not have had it invested in the market in the first place. If you're in a situation where you have money in the stock market that's used for your kids' college education next semester or used to purchase for a down payment on a house, I would sell immediately, Hansen said. The upside, while that money is down in the short term, it's still up over the past couple of years, Hansen said. Investors with a time horizon of 5 years or less may also want to consider moving to a so-called stable value or fixed income funds, Jenkins said. While the returns on those investments are lower, you also don't have the risk of losing 20% to 30% of your money, he said. Instead of reacting to the markets, investors should base their allocations on where they are in life. If you're 70 years old, you have no business having 70% of your money in the stock market, Jenkins said. You should have 70% of your money in fixed income. Financial advisor Margareta Chang, CFP and CEO of Blue Ocean Global Wealth, said she encourages investors to allocate their investments in buckets. Money for short-term goals should be in safe investments, while funds for intermediate and long-term needs can gradually get more risky. Retirees, in particular, may want to put money for required minimum distributions in a stable value fund or short-term fund, Chang said, where they likely will not have to sell at a loss. Those mandatory distributions start when you reach age 70 and a half. Down or volatile markets provide an opportunity to buy stocks when prices are lower. That means you want to keep contributing to a retirement fund such as a 401k, when you'll be dollar cost averaging, or buying investments on a fixed schedule, Chang said. If they're not comfortable, they can pare down the risk in their existing dollars, but keep their ongoing contributions the way they are, Chang said. More from personal finance, retiring in a down market can mean 2/3 less money for the rest of your life. AIG Retirement CEO investors steering clear of emerging markets bonds due to currency volatility. 60% of Americans say their finances haven't improved since the 2016 election. Another tip to consider when markets are low: ask your payroll department to take more out of your paycheck to put in your 401k for one pay period, Jenkins said. As long as you have money in savings to pay your bills, putting more money in the market when it is low can mean a greater upside when it recovers. That can be a really good opportunity, Jenkins said.